Welcome to Iron Financial, the show that forges stronger portfolios by stress testing the market. We don't do hype here. We deal in hard numbers, and we look for structural integrity. Today, we are putting Cognizant Technology Solutions, that's ticker CTSH, right under the microscope. They've just dropped their Q4 earnings, and yeah, the headlines, they look pretty strong. But our job is to go way beyond the press release. We're going to get out the blueprints, we'll get out the sledgehammer, and we are going to determine if this company is a fortress built to last or if it's just a facade that's waiting to crumble.
So here's how we're going to break this down. We're going to build the case for this company piece by piece, and then we're going to see if it actually holds up under pressure. First, we'll look at this victory lap they seem to be taking after the earnings report. Then, and this is crucial, we'll dig into the financial bedrock to see what it's really made of. After that, we stress test the weak points. We're actively looking for cracks. Then we'll analyze their absolutely massive bet on AI, check the valuation to see if the price even makes sense right now, and we'll wrap it all up with the final iron financial verdict. Let's get to work.
Okay, let's just dive right into it. The very first thing that just jumps off the page from this earnings report is a huge dose of confidence, and it's coming right from the top. You have to understand, management is setting a very specific narrative here, and it's one of, well, unqualified success. They're not just saying, hey, things are good. They're basically saying the mission is accomplished.
Right. I mean, listen to that quote. That is a bold, unequivocal statement from the CEO, Ravi Kumar. He's not hedging his bets here. He is claiming total victory. He's suggesting the turnaround plan isn't just on track. No, it's complete, and they are back in fighting form way ahead of schedule. Now, when a CEO makes a claim that specific, you really have to pay attention. And to be fair to him, the headline numbers they just posted, well, they seem to back him up.
Now, what's really interesting here is the consistency you see right across the board. They beat the Wall Street analyst estimates on the top line, bringing in $5.33 billion in revenue for the quarter. And they beat on the bottom line with a non-GAAP EPS of $1.35. Now remember, that's their adjusted profit per share. It strips out some of the one-time accounting stuff, and it's a key metric that the street watches like a hawk. And look, this wasn't just a strong quarter. It capped off a really strong year. Full-year revenue hit $21.1 billion. That's up a solid 7% from the year before. And even better, full-year adjusted earnings per share grew by a really powerful 11%. So on the surface, this thing looks like a well-oiled machine just firing on all cylinders. This is the exact story the CEO wants you to see.
Okay, hold on. A victory lap? The CEO can say whatever he wants on a conference call, but we're here to kick the tires. Beating analyst estimates by a couple of pennies is one thing, okay? But building a durable, long-term investment that you can actually trust your money with? That is something else entirely. We've all seen plenty of companies beat a quarter and then just completely fall apart. So is this real fundamental strength we're looking at, or is it just a fresh coat of paint on an old structure that might still have some really deep foundational issues? That is the real question that we need to answer.
Fair point, and that is exactly where we're going next. Let's move to the actual blueprints and see how this thing is built. So, forget the talk, forget the narrative for a second. We are digging into the hard numbers that form the real foundation of this company. The bull case, if there is one to be made, it has to start with their ability to win new business and how they manage their balance sheet. That's the bedrock. Everything else is just noise.
Okay, look at this number. This right here is the engine room. $28.4 billion in trailing 12-month bookings, and that's up a solid 5% year over year. You have to understand, for a company of this size, that is a massive pipeline of future work. This isn't revenue they hope to get, this is revenue from contracts they have already signed and locked in. For an investor, what this number really represents is visibility. It's a pipeline of predictable income that underpins the entire operation for the next year. In this next number, this is what really shows the momentum they are building. A book-to-bill ratio of 1.3x. So what does that actually mean? It means for every single dollar of revenue they completed and recognized over the last 12 months, they booked $1.30 in new future business. Think about that. Their pipeline is filling up faster than they're draining it. That is a fundamental sign of a healthy, growing enterprise. You simply cannot fake that number. And this momentum, it's being fueled by some major wins. In the fourth quarter alone, they signed 12 large deals, and 2 of those were what we call mega deals, worth over $500 million each. They are landing whales.
Now let's talk about the structure itself. A company can have great sales, but if the balance sheet is weak, the whole thing is built on sand. Cognizant, this company, is built on granite. You see an operating margin of 15.7%, a net margin over 10%. That shows they're profitable and they are efficient. The current ratio of 2.36, that just means they have more than twice the current assets they need to cover all their short-term bills, so there's no liquidity risk here. But let's focus on the number that truly defines this as a financial fortress. Look at the bottom of that table. The debt-to-equity ratio is 0.08. To be crystal clear, that means for every dollar of shareholder equity they only have 8 cents of debt. They are practically debt-free. This company is built on its own capital, which gives it immense flexibility and durability to weather any economic storm that comes its way.
And they are putting that incredible financial strength to work directly for their shareholders. They've just announced a plan to return $1.6 billion to shareholders in the coming year. That breaks down into $1 billion in share buybacks, which reduces the number of shares out there, and an increased dividend, which they just hiked by another 6.5%. This, right here, is the definition of a financially sound operation. They generate tons of cash, they have no real debt to service, so they return that cash to the rightful owners of the business. That is the bull case.
Okay. The foundation looks solid from a distance. The balance sheet is clean. I will absolutely grant you that. But at Iron Financial, this is where we bring out the magnifying glass. We start looking for the stress fractures. Any structure, it doesn't matter how well it's built, can develop cracks under pressure. And I see a few things here that we need to examine much more closely. So let's start with the workforce, the actual people doing the work that's generating all this revenue. Okay, so the company is highlighting these employee metrics as a major positive. They're pointing to the fact that voluntary attrition, that's the rate at which people just choose to leave on their own, is down to 13.9% from 15.9% a year ago. And at the very same time, their total headcount is up by almost 15,000 people. They want you, the investor, to see this as a clear sign of a happy, stable, and growing workforce.
But you have to ask the tough question here, right? Is this some kind of newfound loyalty, or is it just a lack of better options? We all know the broader tech job market has cooled down significantly from that absolute frenzy we saw a couple of years ago. When the entire tech sector is tightening its belt and laying people off left and right, lower attrition isn't necessarily a sign of internal strength. It could just be a reflection of external weakness. It might just be a sign of the times. Now let's stop talking about what the employees are doing, and let's talk about what the executives are doing with their own money. And right here, this is the first major crack in this whole winner's circle story. While the CEO is on the earnings call taking a victory lap, the insiders, the C-suite executives who know this business better than anyone on the planet, have been selling stock. And not just one or two of them. We're talking about 17 separate insider selling transactions in just the last 3 months. And how many insider buys were there in that same period? You'd expect to see at least a few if the story is really this good, wouldn't you? The answer is 0. Not a single one, a big, round goose egg. You know, actions speak a whole lot louder than press releases.
And let's look a little closer at that impressive 7% full-year growth number he was so proud of. The press release is very clear about this, but you have to read the fine print. Their acquisition of a company called Belkin contributed 260 basis points, or 2.6 percentage points, directly to that growth. So do the math. More than a third of their celebrated 7% growth wasn't organic. It wasn't from selling more of their own services to new or existing clients. It was bought. This makes you seriously question how strong the core business really is. Is this a true growth story, or is it an acquisition story that's designed to mask slowing organic growth? That's a critical distinction for an investor to make.
Those are valid stress points. The insider selling is a concern. It absolutely needs to be watched. And the acquisition growth is a fair clarification. But you're focused on the past and the present. The real heavy lifting, the real investment right now, is being done to fortify this company for the future. And that future is, without a doubt, artificial intelligence. This isn't just talk. It's not a new line item in a presentation. They are strategically building an AI fortress through key high-level partnerships with the biggest names in the game.
They're not just using AI tools off the shelf. They are embedding themselves with the players who are creating the entire ecosystem. They've expanded their partnership with Microsoft to co-build and co-sell AI solutions directly to enterprise clients. Now, this isn't about just licensing software. This is about deep integration and going to market together on massive deals in critical sectors like finance and healthcare. They're positioning themselves to be Microsoft's go-to implementation partner for this revolution.
Next up, they've adopted Anthropic's Claude, which is one of the most powerful large language models on the market today. The key phrase to focus on here is moving clients from AI experimentation to scaled business outcomes. They get it. They understand that corporations are past the point of just playing around with chatbots. They need tangible ROI. This partnership is squarely aimed at delivering measurable financial results from AI at an enterprise scale, which is exactly what the market is screaming for right now.
And this is the potential game changer. They have partnered with Cognizant to use Dividend AI, which is being billed as the world's first truly autonomous AI software engineer. This isn't just about making human developers a little more efficient. This has the potential to fundamentally rewrite the entire economics of software development and service delivery. By getting in on the ground floor with this kind of technology, they are positioning themselves at the absolute cutting edge of the industry. This is how you build a real moat for the next decade.
It's an impressive list of names, no doubt about it. Microsoft, Anthropic, Cognition. It sounds fantastic, but let's be realistic for a second. Every single consulting and IT services firm on the planet is slapping AI all over their slide decks right now. These partnerships, they're not free. They are incredibly expensive and require massive ongoing investment. The real question for investors is whether this creates a durable competitive advantage, a real fortress, or if it's just what we call AI washing, a very costly and maybe desperate attempt to look relevant in a hyped-up market. The proof will be in the margins and the profits, and we simply have not seen that materialize yet. It's a big bet, and the bill is coming due.
All right, let's move to the price. Because a great company at a bad price is a bad investment. And sometimes a flawed company at a great price can be a fantastic opportunity. All of this analysis is pretty much meaningless if we don't look at what we actually have to pay for the stock. We need to see if the market is pricing in the strength of this fortress, or if it's getting scared by some of these potential cracks and just ignoring the fundamentals.
Okay, looking at the key metrics, the picture gets pretty interesting. The price-to-earnings ratio is sitting at 17.3. Now, that's not screamingly cheap, but it's well within its historical range for this company, so it's not overvalued. The price-to-sales ratio is 1.76, which, again, suggests a fair valuation. It's not a deep bargain, but you're not overpaying. But the crucial point for a trader, the thing that really stands out on this slide, is the technical picture. The Relative Strength Index, or the RSI, which measures the speed and change of price movements, is at 28.95. As a rule of thumb, anything under 30 indicates that a stock may be oversold. It means the selling has been overdone. This suggests that the market's reaction, maybe fueled by those insider sales we just talked about, has pushed the stock down to a level that might represent a very, very attractive entry point.
All right, we've laid out the blueprints of the bull case, we've stress-tested the structure, and we've definitely identified some potential cracks. We've inspected the brand new AI fortifications they're building for the future, so it is time for the final verdict. Let's put it all on the table, and let's see where we land. Is this an opportunity to buy strength, or is it a classic value trap? The bull case is clear, and it is built on strength. This is a financial fortress. You have powerful, undeniable growth in bookings with a 1.3x book-to-bill. You have a pristine balance sheet with almost no debt, which is an absolute rarity today. They are generating a ton of cash and returning a significant amount of it to shareholders. And on top of all that, they're making a massive strategic push into AI, which is the single most important technology of the next decade. To top it all off, the stock is technically oversold, offering what looks like a great entry point. From this perspective, this structure is absolutely built to last.
But the bear case sees a very different picture. It sees a facade. The insiders, the people who know the company best, are selling, not buying. A huge chunk of their celebrated growth was bought, not earned organically. They are spending a fortune on these high-profile AI partnerships with absolutely no guarantee of a profitable return. It could all just be expensive hype. The valuation isn't a steal, it's just fair. And those positive employee metrics, they might just be an illusion created by a weak tech job market. So you could be buying a company that looks fantastic on the outside, but the internal conviction just isn't there. It could be a classic value trap.
So the analyst's final financial verdict is this. Cognizant is a solid structure with a few visible but manageable cracks. But it is aggressively, and I think intelligently, building fortifications for the future. For an investor with a multi-year time horizon, that rock-solid financial foundation, combined with the immense potential of their strategic AI partnerships, makes this a compelling opportunity, especially at these current oversold levels. The risks, particularly that insider selling, absolutely require monitoring. You have to watch that, but they don't condemn the entire structure. To us, this looks more like an opportunity than a trap. And the ultimate question really comes down to execution. They're saying all the right things, they're making the right moves in AI, but the cost is high and the payoff is not guaranteed. That leaves you, the investor, with the final call. Do you trust management to turn these expensive AI partnerships into profitable growth, or are the insiders telling you the real story with their actions?
Thanks for watching Iron Financial.